Chinese AI companies are likely going to replace a lot of the American AI companies that we see today. For months, this AI trade has carried the entire US stock market, but with the recent headlines coming out of China, that may very well change in the near-term future. And in this video, we are going to talk about exactly that. Now, I want to start off this video by highlighting the two most common semiconductor ETFs in the US. So again, that is the VanEck semiconductor ETF. We have the iShares semiconductor ETF, and both of these ETFs are down, pretty heavily from their all-time high. So iShares, right, we're looking at negative 21% since the May in June, so that's last month. And for the VanEck semiconductor, it is down 17.7% from its high in June. And so a lot of people are wondering, is this the beginning of the end when it comes to the US stock market and this so-called AI bubble? Now, there's a very specific reason why we are seeing people lose faith within the US AI companies, and that is exactly what we're going to talk about. So again, China, right, recently released something called Kimi K3. And again, that, according to this Business Insider article, has Silicon Valley quaking. So what is the Kimi K3? Well, it is a new artificial intelligence model from Chinese startup called Moonshot AI. And Kimi K3 is an open weight model that Moonshot AI says rivals some of the best systems from OpenAI and Anthropic, but at a much lower cost. So I saw a post the other day that pretty much said with the Kimi K3, what previously cost about $1,000 using any system from OpenAI or Anthropic could now be cut down to about $60 using the Kimi K3. So again, you're looking at similar results, but much, much cheaper. So again, China just, repriced the entire AI race because again, it's a sharply lower cost and it's a fraction of the cost to run those models and systems, holding up in third-party valuations, and it's built with minimal human supervision. So again, this also means that it can run more automated, right? We do not need huge teams to monitor these systems, and again, they come at a much cheaper price. What we've also seen, especially in the physical AI sector of China, which we'll touch on later in this video, is just how much faster they're moving relative to the US. And you might wonder, well, what does this have to do with the US stock market? I mean, are my stocks in danger of just selling off? Are you going to lose money? And I want to talk about the danger, okay? And in order for us to do that, we have to look at, PE ratios for different companies. So what we're looking at here is Broadcom, okay? And I want to highlight the current PE ratio. So if we take a look at where it's trading right now at about $370 a share, you can see that the PE ratio is 61.7, which is pretty high. So again, this means that the future expectations regarding, the growth of Broadcom as a company, are severely high. We can also have a look at Marvel, right? Another company that Jensen Huang recently called out. You can see has a PE ratio of 64. So again, also pretty elevated with a share price of $188. Now, what I'm about to show you might shock a lot of people. There's a significant chance that you hold this stock as part of your portfolio, yet it is one of the most overvalued companies in the entire world right now, in my opinion, and that is Tesla. So at a share price of $380, it has a PE ratio of 349. I mean, that is astronomically high. People are essentially pricing in a perfect future for Tesla. Now, later in this video, you'll understand why that future might not be as perfect as a lot of people believe and why it can be incredibly dangerous to price in an asset, expecting perfect growth. And lastly, we have another famous stock or ticker called Palantir with a PE ratio of 148. So again, also, severely overvalued. Now, luckily for us, right, we have already gotten a stock or a company that kind of proved to the entire world what would happen if some of these large companies with extremely high valuations end up missing expectations. Now, the company I'm talking about is Broadcom, which again, we just covered it, right, has, an elevated PE ratio. And in June, so last month, they actually ended up missing expectations. So their 7-quarter revenue of $22.19 billion missed the estimates of $22.27 billion. So again, this is not a huge miss. The estimate was 22.2. The actual was 22.1. So again, nothing major. And I just quickly want to highlight the actual revenue behind Broadcom, because a lot of people might automatically assume that this is just a bad company. In 2020, their annual revenue, right, sat at $23.8 billion. Now, fast forward just 5 years, it now sits at $63.89 billion for fiscal year 2025. I mean, that is explosive growth. And if we take a look at the Q2 of 2026, it is up 48% year over year. I mean, the growth behind Broadcom is crazy. Now, despite that, right, despite the actual growth, the stock still managed to crash 23.5% following the headlines. In fact, that's what we are down from the all-time high right now. But if we take a look at the overall crash, it was about 26.75%. And again, following those missed expectations, right? Now, this goes to show just how ridiculous the expectations are. Because again, Broadcom has done great, but it still crashed 25% on a headline about missed expectations. What's really important to understand here is how large Broadcom actually is, right? So it's not just, a small company. It's not a small cap stock. In fact, by market cap, it is the 7th largest, stock in the entire world or company. So right now it has a market cap of $1.7 trillion. It's larger than Meta. It's larger than SpaceX, Tesla, Samsung. So again, we're talking about one of the biggest companies in the entire world crashing 25% due to missed expectations, even though their revenue is insane. Now, an argument a lot of people like to bring up when they try to argue the fact that what we're seeing now is not similar to the dot-com crash in the year 2000 is that, back then, billions of dollars were poured into companies with no revenue and no business plan. And so that's not the case now, therefore it can't happen, right? That's what a lot of people like to say. However, Broadcom had a very clear business plan, right? They had explosive growth, revenue-wise, yet it still managed to crash 26.7% on a singular headline following a slight, missed expectation. So this really just goes to show what can happen to the broader stock market if multiple AI companies are hit. Now, China, again, just gave us a reason to believe that these companies could in fact miss expectations moving forward. So let's talk about Tesla. Okay, the reason why the PE ratio is astronomically high, and especially relative to competition, is because it is no longer being priced as an automotive company. In fact, according to this article, Tesla is now seen as the physical AI leader, okay? And so it is being priced as a physical AI company without ever really becoming one. Now, if we look at the actual graph behind Tesla, you can see that we topped in December of 2025, and ever since then, we are down about 22.8%. So again, it's not as if the chart just screams for a high valuation. That's really not the case here. Now, what's scary is, again, Chinese companies just doing it a lot better. For example, XPeng. So they recently shared their achievements in specifically physical AI, and they unveiled robo-taxis, next-gen iron, and a flying car. So suddenly, we're looking at an emerging competitor for a company like Tesla, and if this now, right, XPeng now becomes successful as one of the dominant leaders of the physical AI sector, which by the looks of their achievements, is totally plausible, well then things could get very, very ugly for Tesla, and Broadcom proved that. So for example, let's take a look at an automotive company that is in direct competition with Tesla. As I'm sure you guys know, BID, right, the Chinese car company. So right now, the PE ratio for BID is sitting at 40. Now again, add 300 and then you're at Tesla, right, at 349. Now you might make the argument that, Tesla might have, just that much higher revenue, and so therefore it is valued much higher. But that's not the case, because BID actually outperforms Tesla in terms of revenue. And this right here is picture perfect proof that Tesla is not being priced in as an automotive company. It is in fact being priced in as an AI company. Now, it's not only XPeng. For example, Pony AI, they have Gen C robo-taxis, and they are targeting below 230,000 total vehicle cost by 2027. Now, what's really crazy is the fact that the Chinese company Pony AI is expecting to double their robo-taxi fleet this year. So at this current moment, they have about 1,600 active robo-taxis, but they are in fact expecting more than double the fleet of robo-taxis powered by its technology to over 3,000 units across more than 20 cities globally this year. That is about 44 times more than Tesla. So Tesla's active fleet at this time is about 33 33 cars, right? 33 vehicles, whereas Pony AI is about 1,400 and expected to be 3,000 and above this year. So we're not only looking at China being threatening in terms of, pure cost, but also in terms of just development as a whole. It is just much faster. And so we all know, right? The leaders in these narratives are often the people that set out first. And so if the Chinese markets now completely dominate on a global scale before Tesla even gets a chance to catch up, well, then even if Tesla delivers a product that might be better, well, then we already have a leader, which might be Chinese. And if that's the case, well, then, Tesla is going to suffer immensely. China is essentially building the robots that the West is still prototyping. So 85%, this is crazy, by the way, 85% of global humanoid shipments in 2025 were Chinese. 2026 shipments expected is over 28,000 units. AGI Bot and Unitree each, 5,000 plus. Tesla and Figure AI each a few hundred or less. So again, being outpaced by a mile. Average price versus foreign models. Foreign models are about 20% cheaper, and the cheapest Chinese models are below $6,000. So again, this is part of the reason why we're currently seeing, a retracement within these semiconductor ETFs. People are simply losing faith in the AI development in, the West. Right now, they have two choices, right? They can invest American, which is expensive and slow, or they can invest in China, and which is, cheaper and faster. So, the answer here is obvious. And it's not only, physical AI. Meta has also come out and said that right now, they're getting outpaced by Chinese companies because they are just mass producing AI agents way cheaper. So this is, in my opinion, one of the largest threats to US AI, right? China is simply the better option right now, if you ask me. Now, the entire US market is also being held up by a lot of these AI companies. And so if people now pivot from the US, right, towards China, well, then companies like Palantir, Tesla, Nvidia, Broadcom, and Marvel are way more likely to miss expectations because attention has gone elsewhere. And we've already established the immense valuations looking at their PE ratio. And so if that happens, well, then things are going to get ugly. And Broadcom already proved that. Now, I'm not saying that this is an immediate issue or it is a definitive outcome, but I am saying that it's something that we need to consider, and it's something that we seriously need to look at. So let me know in the comment section down below what you're going to do. Are you betting on China? Are you betting on the US? What do you actually think the future is going to look like? Is it going to be dominated by China, or is it going to be dominated by the United States? And also let me know exactly what type of content you would like to see from this channel in the comments down below. Ladies and gentlemen, thank you for watching, and I hope to see you in our next video.